one thing that I think is good to kind of cover off is if you could give us a quick depreciation 101 for some of the listeners out there that may not have a background of what the heck this field is. I think that'll be a good frame, base.
Think about it like a property valuation. You get a valuer out and they say your property's worth X. Now that's a sale price, right? What they're expecting that the property could be sold for or has a value. We sort of act in a similar way. We go and we do an inspection, we take photos and notes, give you a report, but we're really just looking at the built environment. So what's on the land? The land is a non-depreciable component. So we estimate the construction value as at the date that it was built, the value of all of the improvements. And when you're renting out a property, you're able to claim tax deductions based on the decline in value of those assets. Because if you think about investing in property, you're sort of running a business, right? Like you're renting out the property to a tenant, they pay you, but the government gives you an allowance for the fact that you're using that property as an income producing asset and it's going to be wearing out. So a depreciation schedule is really just a report saying this particular year you can claim X amount of deductions based on that property being used as a business.
Yeah. So I think you've encapsulated why people should care there. But if you want to hammer home, why should people? What are some of the reasons people should get it? Why should people care about tax depreciation?
Well, I mean, if you don't, you're just paying more tax. I mean, this is not a loophole. We've had two elections on negative gearing where they're like, negative gearing's a loophole. I'm pretty sure it came in 1936. And it is written into like the Income Tax Assessment Act. So it's not actually a loophole, right? This is an entitlement. And as an investor, you're providing rental accommodation. And we all know the government is really out of that business. They own next to nothing of private rental stock. So there's a value in that. And if you're not doing that, then you're not maximizing your cash flow. And that can stop you from reaching your goals in the time frame you want to. So I think it's really important. What I wanted to sort of start with is let's look at where we're at. Like, where is the property market at now? This graph was prior to the CoreLogic things that came out today. What a way to ruin a presentation, right? But what's really stark about this is you see that little blue line. It's the steepest rate of property falls that I think has happened since CoreLogic have had their data, right? And we're down 8.6% since the interest rate changes. But to put that in context, does that mean this is a worse property market than it was in previous downturns? Well, no. What preceded that was an incredible amount of transactions and property price appreciation as part of the boom that happened, after the pandemic sort of calmed down. And this is an unprecedented amount of RBA interest rate increases. So, that's why the graph looks like that. And yes, it's likely to continue that decline. But I don't see that we're going to be talking about these 30% drops. And this little doodad here, this slide is I think important to remind us that in 2019 there was about to be a boom, right? The property market was already booming, right? But then COVID happened, and for a fair amount of time, we didn't know what was going to happen. Like, I was thinking, I need to get more tinned fruit. Do I need a shotgun? Like, what manner of the apocalypse are we expecting to see? But then the property market went absolutely crazy, and I think that there was a lot in it that needed to be slowed down, right? You look at some of the markets like Brisbane, it's like you wait a month and your suburb has now gone an extra 5 kilometers away. I heard that from buyers agents. You wait another month and it's like, okay, well, you were like New Farm and now you're Ipswich, right? So you just, press the button before you end up in Alice Springs. It was absolutely insane.
I saw a post, or I think it was on Twitter. I regularly follow the property bears because it's funny to see what they're saying. They were saying that Kedron, a suburb sort of area in Brisbane, is apparently the median has dropped like 35% or something. Which I don't know. Can we address? What are your thoughts on medians being, because the problem I have with them is you're not buying the median house in the suburbs.
Yep.
So, you're going to get to that, are you, Mike?
There might even be. I don't want to give it all away, mate, and I don't want people to see how many slides I have and then disappear. But point two, like this is kind of like, all right, well, what do we do about this stuff? Number two, median measures are a bag of
add a bag or add or are or
add a bag. That's good. That's good. That's good copy editing there, Jeff. The reason why I think that's
wait, what are we looking at? You're jumping around. I don't know what's happening.
My fault. I apologize for that.
No, that's all right. Like so the reason why I think medians are problematic, and medians can be useful when the RBA is speaking or CoreLogic is speaking. Broadly speaking, national house prices are down by this amount, but we already said markets within markets. But then, the esteemed Kent Lardner, who I know is a friend of the show, he's shown a number of times how the types of properties that are selling can have a huge impact on the median. So, the medians, it's not always a good indicator of what's happening in that market.
Yeah, I see it all the time, especially with properties that have waterfront properties. They may have, $1 million properties, but then there's a highway in between that suburb, in between the waterfront, and then maybe not a highway, but maybe a main road or something like that. On the other side of the road, it's $500,000. It's $550,000, and then all of a sudden, the median house price, it's $750,000. So you go and buy in that $500,000 suburb at $600,000 because you're like, wow, the median's, 750. You're making a big mistake there. So it's about, I guess, identifying the pockets within the pockets and buying at that price, making sure you're stacking up your comparables.
And it's not even in a rising market, the same thing does happen as well. I mean, it probably gets overinflated a median in a rising market. Maybe I don't know. Whereas in a declining, it probably looks worse than what it probably is.
And it really tends to sort of be impacted by the prestige property market, because there's a disproportionately high value property and often the first to come off. Right, so some of the cheaper suburbs in Sydney might still be seeing growth, but the premium end of the market is bringing it down. So that's where I think it's quite problematic to talk medians.
Yeah, and I mean the high end grows the most, it kicks things off, but then it drops the most as well. So you really got to be a little bit more time sensitive, I think, if you're going to the high end.
Can drop the most. I mean, I wouldn't say it does. I mean, unless you've got data on that.
It's actually showing some the prestige market is showing really some resilience now, and I wanted to talk about some resilience and getting a little bit of perspective here. So the bit that I've highlighted has said that prices remain well above where they were before the pandemic, right? So everywhere but Melbourne, up until the recent data that came out today, which again sort of ruined it. But the National Housing Value Index down 8.9% since peaking in April last year. But the National Home Value Index was up a stunning 28.6% in the space of just 19 months. So I think we're getting very, very drowned out by the media talking about the property price declines, but without the context of, well, we've just come off a huge boom and the vast majority of Aussies have got more equity today than they did pre-pandemic, and that sort of gives us a bit of context on what's going on in the market.
And why do you think there's no one's listing their properties? Like, why is there a limited supply of stock coming to the market?
Well, during the pandemic, there was something like 640,000 transactions. So a lot of the buying activity has kind of actually happened. There's a lot of people that upgraded in that market. There's a lot of people that purchased. And I think the people that have sort of sold their property wanting to lock in the prices when the market was buoyant. The inverse of that is people not wanting to sell when they're thinking the market's going down. They'd be more inclined to hold on to it. And there is a real important psychological thing at play with loss aversion. Anyone that bought at those high prices, there's a real strong need for them to not sell their property at a loss. They'd be much more likely to ride it out if they can.
Like, what's stopping those buildings happening? Why aren't people able to build as much as what we used to be able to?
Yeah, look, well, I suppose it depends on the appetite of the developer and what their expectation of the result is going to be. At the beginning of the pandemic, we saw a huge spike in vacancy rates in the inner city apartments because these were locations that I was looking at in the rent loss index that we were putting together, and investors in those locations like South Melbourne and certain parts of Brisbane and in and around the uni precincts in New South Wales, in Sydney, the vacancies were crazy because we had a lot of the international students disappear. And that's become a lot tighter now. But just the cost to actually get these properties built is a real problem. It comes down to a lot of different things, but mostly it's the materials availability and the materials handling. We've got an under-resourced construction sector, and even little things like the East Coast low and the floods. We lost some 130,000 hectares of commercial plantation, so that's impacting the price of timber and things like that. Wow. There's also been global demand that's influencing things as well. So like 2022, the US building sector had its biggest year since the GFC, up 25% on 2019 numbers. And when you consider that about 60 to 70% of our construction materials come from China, and we had international shipping issues, we had the COVID issue in China and the COVID zero stuff. There's a lot of pressure on the construction prices because of those influences.
Any other kind of big depreciation changes coming that we should be thinking about or considering as property investors that you're seeing out there?
The thing is that the biggest change really in my career in tax depreciation was in 2017 on the 9th of May. And that was a surprise. I was watching the budget speech with a glass of wine. This one actually had alcohol in it. It was good stuff too. But I had to just leave it and drive straight into work and model what the impact of those changes were. So when you sort of say, like, is there anything coming? Well, I didn't know that was coming. And that was a huge change, right? And not a lot of people understood what that actually meant. I was crunching data and sending that to Louis Christopher and Pete Wargen because they were probably getting a little bit more airtime than me. So I thought, I'll send them the stuff, like at least it gets out there. So there's nothing that I see coming up. But I mean, that's an interesting thing that we could think of from a rental affordability thing, right? So depreciation deductions since 2017 have been eroded, right? So on average, we're probably sort of saying somewhere around 20 or 30% of the deductions that you would have got prior to that legislation, you're not getting any more. So that's actually made investing less attractive. Now, that's probably not enough to influence investor activity so much, but I think when you add that with two elections talking about banning negative gearing, where people are trying to set their financial future up and make long-term decisions. We've got the Queensland government talking about their land tax changes, where they're going to tax you for every property you own across Australia. The Greens are talking about a cap on rental increases. There's been huge legislation changes for renters in Victoria around minimum standards, and not all of that is bad, right? As investors, we've got an obligation to provide a nice, safe place. But there's been a lot of pressure put on property investors that has made them reconsider whether they actually want to be investors anymore. And we probably saw that data borne out in the Pippa survey, where we saw a lot of investors exit the market. So I think the government has got to accept the fact that unless there's some panacea out there, or they decide, look, we're going to build, 1 million homes and rent them out for $200 a week. Unless they're going to do that, the solution really lies with property investors and demonizing them, such as has happened in the political discourse, and putting these kind of arduous things on them, and show cause evictions and all sorts of things like that. I think that is part of the problem. I really think that this rental affordability crisis was in many ways manufactured by poor political decisions.
Underinsurance.
What is underinsurance? Well, forget about the definitions. What I want to talk about with underinsurance is it's the sort of new mantra that we have in our business. Is we're talking about maximize and protect. Maximize is an obvious one because we want to put our investors in front of educational content that helps them maximize their goals and their outcomes, and of course tax depreciation maximizes their cash flow. But we go to all this effort to acquire properties, or even just the one property, but we're not protecting them in a meaningful way. 83% of Australians were underinsured, according to the Property Council of Australia. Now, that is pre-pandemic. So that's prior to these crazy increases in construction costs. So that number is likely to be a lot higher than that. So you can see there's the history of underinsurance in Australia. CanStar said 77% of residential owners are underinsured in 2013. And the ABS even said that 23% of all homes have no insurance. And the weird thing to think about is that many of those are mortgage-backed. So there's banks that have exposure to uninsured assets, which kind of just seems crazy. But presumably that's all kind of worked out in their risk models. And who knows, we might be paying more fees and more interest because of that fact. So non-insurance is actually a real epidemic, and it's pretty sad when you look at the demographics. It correlates with people living in cities, born overseas, lower levels of education without full-time work, just the people that really need that insurance. I'm guilty of this myself. I mean, my first home was a shithole. I can say that, right? And I think most first home buyers can relate to that, right? It's, you got to start somewhere. And I can remember seeing an ad for a building company, one of the big building companies showing this project home is like, we can build this for like $220,000. I'm like, wow, that is so much better than my house. I'll insure my house for $220,000, and then I'll just I'll just get that. So that's way more than I need. But what people don't understand is that if your house burns down, or there's some natural disaster, you're not necessarily getting a brand new flat block ready for the building company to come in and do it. There's demolition costs. There's cost escalations with the tendering period. It might be something that's built in a way that doesn't fit code anymore. It's too close to the boundary, or for older dwellings it's fine, but there's now new bushfire regulations, or there's BASICs, or there's airport noise abatement issues, so you need double glazing. There's a million different reasons why people don't understand that the cost to rebuild a property is not the same as the cost to build a property. And the issue is that when you talk about underinsurance, there's something called a co-insurance clause. So if you are underinsured, then you're not going to get your insurance amount back. Another way to put that is, let's say you got a house that has a rebuild cost of $1 million. You insure it for $800,000 and the whole thing burns down. You're not going to get your $800,000 of insurance because you've underinsured it by 20%. The insurance company will say, well, you took a risk by underinsuring that asset and we didn't agree to that, so we're only going to give you 80% of that $800,000. So then, you go through this issue of, having your life destroyed, and then you've potentially got that tap on the shoulder to say, you're going to have to chip in here. Mother Nature is really, really annoyed with what we've been doing to her, and these events become much more frequent. And underinsurance is an epidemic that we're pretty passionate about trying to share people's understanding of it. And some of the big problems come from valuation reports where valuers will put a replacement cost estimate on something. They're not qualified to do that work, and there's a disclaimer in their report saying that they need a quantity surveyor to do it, and people using online calculators, which just aren't really good enough. So people really need to be able to understand their construction costs. Now, we do replacement cost estimates for insurance. We do these reports. We do them at a flat fee of $600 plus GST for anything under $10 million. And that includes commercial property where they've got plans as well. But the appetite, I've got to tell you, in the residential space is not there. People are happy to pay me $600 or $700 for a depreciation schedule that puts $3,000 back in their pocket. But will they pay $600 to say you're underinsured, you're risking that asset, so now you really ought to put your premium up? The appetite is just kind of not there. We fear the tax, and we want to get that back more than we think about the consequences of underinsuring an asset.